So the title of this presentation might seem a little bit clickbait, but it's pretty valid. So the question is Zoom stock worth $1,500 a share? A lot of readers and subscribers have been raising questions around this, and it has to do with a price target or a series of price targets that ARK Invest has made for Zoom, which happens to be the largest holding in their flagship ETF at over 10%. So when we look at the past performance of ARK's ETFs, as we typically see, everybody loved ARK when they were outperforming the market, but then when the ETFs started to underperform, suddenly ARK's Kathy Wood is Satan. Well, the truth is that ARK takes on a lot of risk, and risk equals volatility. So we would totally expect that sometimes the performance would be above a market benchmark and sometimes it would be below, and it happens to be below. Now, one measure that you can look at aside from performance is net inflows, and that shows the amount of money that investors are pulling out or putting into a particular ETF. In the case of ARK, net inflows were somewhere around $1.3 billion this year. So investors have plenty of confidence in ARK's overall investment thesis for disruptive tech stocks. Now, today we want to talk about their bull thesis for Zoom. And we've written about Zoom before in the context of telehealth, and I'll put a link to that article in the description of this video. But this is what's interesting. So ARK's bull thesis is as follows. Their expectation is that by the 1st of January 2027, the expected value for Zoom's shares will be around $1,500. That's a 1,200% increase. The bear thesis, which they attribute a 25% probability to, would find shares at around $700 or less. And the bull thesis would be upwards of $2,000 a share, which would represent a 1,700% increase. Now, what this boils down to is that ARK seems to believe there's a 75% chance that shares will trade around $1,500 in less than 5 years from now. So we wanted to examine this bull thesis and start by talking about how they arrived at these numbers. Now, I pulled up this simple depiction of a sensitivity analysis, which allows you to model things. So the example given here is somebody who's selling chairs. So if you play with the price per chair or the cost of a chair, your store rent, your payroll, you can quickly see how that affects your overall profitability. And the idea is that you have these variables that you play with to determine an outcome. And what ARK has done is they've used a Monte Carlo method, which simply takes a number of variables, assigns probabilities to them, and then runs iterations to see what the likely outcome would be in a number of different scenarios. It's all very sophisticated, and it's pretty cool stuff. It's the type of work that you would expect to do in B school. Now, here are the 4 key variables that ARK is using to arrive at the price estimates that they provided. And the first here is the adoption of a hybrid remote working model by global knowledge workers. So first you need the total number of knowledge workers, and then you can estimate how many, or say what percentage of those workers are working from home or using a hybrid remote model. And they estimate that at 51%. That happens to be what Gartner says that number should be, that percentage should be at the end of 2021. Then you have Zoom's share of hybrid knowledge workers. So those workers that are using Zoom's platform. Then you have the users that Zoom has monetized, and then what's called the average revenue per user. And what they've done here is taken these 4 variables and run a Monte Carlo analysis against them. And perhaps the first problem that we might encounter is this notion of average revenue per user. This is a SaaS metric we don't come across very often. It's not used by Zoom, which makes it very difficult because then you have ARK and Zoom speaking 2 different languages. But what ARK has done here, they've calculated usage estimates for Zoom from a company called SimilarWeb. In our experience, SimilarWeb doesn't provide an overly accurate measure of traffic for websites, but that's what they've done here. So they've estimated the number of paying users, and ARC says that indeed this should only measure desktop, and Zoom users who use the app won't be counted, so that this actually underestimates. We would question how accurate the estimate is in general, but they say 212 million users at Zoom, 17% have been monetized. Again, the logic for arriving at 17% isn't articulated in the model, but what they arrive at are 36 million users. Well, they take the revenues for Zoom, divide them by those 36 million users, and they have this $113 average revenue per user. So the question is, well, does that mean that 36 million paying customers have inputted 36 million credit cards to Zoom? And that seems highly unlikely. What we see when we look at Zoom's language is that they describe their customer base in terms of the number of employees. So we took this from their investor deck, and it shows that 64% of Zoom's revenues come from companies with more than 10 employees, and 36% come from companies with less employees. And Zoom is actually in the process of changing how they describe their customer base. So historically, they've provided this number of customers with more than 10 employees. You can see that on the right-hand side here and how that's growing over time. And then this important metric on the left, which shows customers contributing more than $100,000 in trailing 12 months revenues. Right now, the average contract at Zoom is about 10 months, and that's slowly increasing over time so that they have more enterprise clients on annual subscriptions. And that's the language that Zoom plans to use going forward. They describe an enterprise customer as a company that their enterprise sales team has engaged with. And what they're going to do going forward is just break down these two categories. You have online, which could be just somebody with a personal email address who signs up to Zoom, versus enterprise, which is their focus. So they hope to start capturing more enterprise dollar by upselling and cross-selling. So let's take a look at the model that ARK Invest has put together, which you can see here. So what we've done is simply zeroed things out. So take a look at the yellow highlights there in those two columns, one labeled 2022, one labeled 2027. And up at the top, you can see total revenue. Then you have implied price per share. This is actually pretty close to Zoom's current price, which is around $110 a share. And using ARK's model with everything zeroed out, you can see that it comes pretty close to that. So you have the actual revenues of 2022, and then going down, you have Zoom's monetization share and the average revenue per user. So if we just, and that's what you would expect, put the model as a baseline to what the numbers are today, then it should roughly equate to today's share price, and it does. Now, when you go and start to run a Monte Carlo simulation, and anybody can access this spreadsheet and play around with the numbers, ARK did a great job of making that available so that you can see how this works. Now, here you can see a simulation run with a number of different variables. So if the total number of global knowledge workers is much higher at 705 million, and Zoom's share is higher, and the monetization is higher. You can see the monetization there was 36, but now it's 102. So that would mean they've monetized 102 million users at a average revenue per user of 524. So that's more than 4 times what it is today. Then they should have revenues in the range of $53 billion by September or January 1st, 2027 versus $4 billion today. That's some huge growth. Now, the first problem that we seem to run into here when we talk about users is whether or not we consider participants in meetings to be users. So this was a article, I believe, published by I can't recall the media firm that published this, but they talk about how Zoom admits it doesn't have 300 million users, and you can see how they've changed some language here. So it says, Zoom originally stated it had more than 300 million daily users, and then they changed the language to say 300 million daily Zoom meeting participants. This is very important. So when we look at plans for Zoom, for example, you have the Pro plan. So if an individual signs up for the Pro plan and they can host a meeting with 100 participants, and they do, you can't say that that reflects 100 paying users. You can say that reflects one paying user who hosts a meeting with a large number of participants. So this language between, or this definition of a user versus a participant becomes very, it's not very clear. So the fact that ARC's based their entire estimate on this ARPU number makes it very difficult to try to reconcile that with what's actually going on. Now, when you look at ARPU growth, so just going back to that earlier spreadsheet we looked at, revenue increases because the number of paying users increases, or the revenue that you're getting from your paying users increases. So they're assuming that they'll be able to generate a lot more revenue per user. And here's where that's going to come from. So you can see webinar events make up a big component of that. And probably the most bullish aspect of this ARPU increase would be AI enabled products and services. And in the podcast that ARC put out, where there are two analysts who did an excellent job of putting together these spreadsheets and all this presentation, they talk about how a key selling point for investors on Zoom stock would be the fact that they have a lot of data that they can now use to produce AI-enabled products and services, and that productivity can double, so that companies will sink a lot of money into that. And in the most bullish case, a company is spending as much on the actual subscription as they are on an AI-enabled products. That's pretty bullish. So when we look at the end results of running this Monte Carlo simulation, here you can see how they've come up with the numbers that we saw earlier, and you can simply play around with those yourself. Now, when we look at ARPU, because that's a very critical component of ARC's estimates, here's a look at the three different scenarios. So the first would be ARPU at $188. That assumes that the user is paying $250 a seat at a 25% discount, okay? And then you go down here and you can see how they become more optimistic. In this second ARPU estimate of $356, you can see how they're also adding in other components like Zoom event licenses for up to 10,000 participants for every 1,000 knowledge workers. And there's an assumption that enterprises will spend 50% of their expenses additionally on AI functionality from Zoom. And then, of course, the most bullish says that a Zoom events license for up to 10,000 participants for every 500 knowledge workers. That's a bit confusing. So you have an events license, you're going to hold an event for 10,000 participants. Do you need one for every 500 knowledge workers in your company? That seems to be a bit confusing as to why companies would need so many event licenses. And then, is a company going to spend 100% of their expense on a Zoom license on additional AI functionality? And ARC's argument is that because Zoom has all the big data, they can manage to produce some very compelling AI-enabled functionalities that customers will want to buy. Now, what it comes down to when you're messing around with those numbers, whether you want to change ARPU or you want to change the percentage of customers that Zoom can monetize, whatever variables you want to play with, revenue growth doesn't lie. And on the left-hand side here, you can see the sharp growth in revenues that Zoom realized on a quarterly basis since the pandemic gave them quite a boost. In red on the left-hand side there, you'll see the coming 3 quarters for this fiscal year. So they've already reported one quarter that was pretty much the same as the previous quarter. You can see how that's flatlined, and now they're expecting growth to grow over the remainder of this year, but not by very much. We've actually taken the most optimistic annual revenue estimate and plugged that in here with those red bars. Now, when you look on the right-hand side here, the path to $30 billion, guess what? This $30 billion, that's their bear case. So it's hard to look at this chart as a bear case, but this would represent, based on Zoom's own estimates of fiscal 2023, This represents the sort of growth they'll need to see, 60% compound annual revenue growth to hit $30 billion, which is the bear case provided by ARC. So it's very, very optimistic what ARC is laying out. And there's a number of things that investors will want to pay attention to, aside from seeing some revenue growth in 2024 that's pretty sharply higher than 2023. And we'll talk about that in a second. But when we look at pre-pandemic versus post-pandemic and some of the arguments here, so people were forced to work from home, and that's resulted in two trains of thought. One is that companies realize everything could be done remotely. Not so sure about that. There's always been the push from employees to work from home, and there's always been some allowances around that. But what you also see on the employee side is a lot of employees saying, gee, I wish I could go back in the office, because a lot of people like to go to work to socialize for whatever reason. And then there's this idea that, well, employees can now demand work from home as an option because they have all the power. Well, we're in a bear market, and there's potentially a recession around the corner, and there's a lot of layoffs. So this notion that employees have all this leverage, not really buying it. And you can look at Tesla's Elon Musk telling employees that now it's time to go back to the office, and other firms in taking various approaches to that. But the idea is that some hybrid model will result with more people working from home than before. We can agree on that, but what does that usage of tools like Zoom look like in 2026 compared to peak pandemic? And that's an interesting question to think about. So you have this hybrid model, but what does that usage actually look like? So Zoom is now focused on doing a land and expand with a focus on enterprises to increase their net run rate, which sits at around 130%. That's healthy for a SaaS business. What we don't have is any sort of revenue segmentation into the success of their product offerings, like their newly released Zoom IQ for sales teams. So they're enabling meetings and various methods of communication, what they call unified communication. They're enabling that now with AI. And the C-level individuals at Zoom were on a call and said that they would expect to start segmenting revenues when they become 10% or more. So they said that all this added functionality now is over 10%, but at a product level, they'll start to provide that granularity when a product reaches 10%. That's great. Watch for that. That's very important, because then you can see how successful the new products they're trying to cross-sell actually are becoming. So that's one thing that investors need to pay attention to. And then when you look at the total percent of global knowledge workers that will be remote, well, we're at 51% supposedly by the end of 2021 going into this year, and that it actually, according to Gartner, is booming this increase of PCs and tablets being shipped, so that more and more workers are setting themselves up to work from home. It just remains to be seen at a global level, especially, how that pans out. Now, one thing to consider here is that Zoom may be a leader. Certainly, they've built a brand, but there are competitors, some being Microsoft, Cisco has been around for quite a while, and then you have RingCentral and some of these other names, including Google. And ARC addresses this by saying that there are really four moats that Zoom has to, let's say, maintain or even increase their market share. And first is that they built some very good infrastructure that was born out of the pandemic boost, and their product works better than other products, and that's pretty important. So when you're looking for remote communication, you want it to work well. They're also enterprise ready, features very specific to business usage. There's this AI data advantage because it's all about the data, and Zoom has tons of data so that they can accelerate their deployment of AI-enabled products. And there's also this ecosystem of integrations, this spider web of connections, where Zoom isn't the evil empire Microsoft. So companies will be more likely to go with Zoom than they would be to go with a firm like Microsoft. Now, when we look at the valuation of Zoom, we just wanted to put this up real quick because it's something we always touch on. Valuation around 7.6. That's the market cap divided by annualized revenues. You can see how this compares to other SaaS firms, and it's you wouldn't say it was undervalued or overvalued. The average on this list is around 12, so perhaps you would say it maybe is a little bit undervalued. If you remove the outliers, it isn't. So that's valuation. Then just to conclude, so ARC's model is impressive. It's very impressive at its level of detail, but it isn't speaking the same language as Zoom. Really the only variable that ports over is revenue growth. So either revenue growth happens as ARC has predicted it will, or it doesn't. And the 4 variables that ARC uses, none of those are provided by Zoom, so it's really impossible to see how they're progressing. That makes it very difficult to put some real credibility into these numbers without being able to monitor how they're progressing. So what it all comes down to is that strong revenue growth needs to happen in 2023, let's say fiscal 2024 for Zoom, at least 60% year over year, so that they're on track to hit these lofty estimates that just happen to be the bear case. Just to hit the bear case, that's the sort of growth that they'll need to see. And that AI is a critically important driver of this growth when it comes to selling customers more functionality. So pay attention to Zoom IQ and see how that's being received by customers in calls and whatnot. And analysts on Zoom's calls are asking lots of good questions, it seems. So if you're an investor in Zoom, you'll probably want to read the transcript. So please go ahead and put any comments in the comments section. Make sure to subscribe to our channel. Thanks so much for taking the time to watch this video today.